I think the risk of recession has gone up dramatically as purchasing power is dropping dramatically. In the U.S., the consumer saving rate already is down to levels we have not seen since 2013. So that buffer that the stimulus payments created during the crisis, that's gone.
Hey guys, welcome back to Library of Wealth. Today we have Ark Invest Cathie Wood giving us her prediction for a recession in the current market, as well as the impact that the rising interest rates and the crashing in stock and crypto markets is having. Cathie will also discuss her financial prospects for the next few months, as well as whether or not there is an end in sight. She believes that the current trajectory is merely a foreshadowing of what is to come. Stay tuned to the end of the video to hear Cathie's predictions regarding the current market meltdown, recession, inflation, and the impact of interest rate hikes on financial markets. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
Cathie, it's been said that you are in the toughest battle of your career right now. Not only are you fighting against the market momentum, you're also trying to halt huge losses and outflows. So I want you to address this for us. What is the message to investors here? Do you think that the street is just getting you wrong, or is it time to concede that mistakes have been made?
So let's put in perspective. You mentioned 60%, which is absolutely right. We have been in a terrible bear market for innovation. Hard to understand, but terrible bear market for innovation. However, if you look from the bottom of the coronavirus to that peak in February of 21, we were up 358%. Why? Because innovation solves problems, right? Now we're down 60%, and we have a whole new set of problems, certainly coming out of Russia and Ukraine. If you look at our strategy over a 5-year period, look at the last 5 years, I'm not quite sure what the numbers are, but they are well above our minimum hurdle rate of return, which is 15% at a compound annual rate. And I think over 3 years, we're closer to 25%. So that helps put our performance into perspective. This is a period, if you believe in innovation, and that innovation does solve problems. We had a preview of that after the COVID crisis, when our strategies in the span of a month, many of the stocks were taken down 75% because either they were burning cash or they had low cash cushions. But guess what? Those were the genomics companies that were going to get us out of the virus. And today, what do we have? We have all kinds of problems, the latest of which is Russia, Ukraine, and all of the commodities coming out of that area, especially hitting Europe.
Wood says that China and Europe are already in a recession. Without recessionary measures, we've never seen such high inflation. It's up to the Fed to bring it under control and skillfully navigate the global economic and geopolitical challenges.
I think we're going to be looking at a lot of demand destruction and substitution into innovation. Electric vehicles as opposed to gas-powered vehicles would be the biggest one. We also have labor shortages all over the place. Again, automation. This is innovation at its best, and it's being turbocharged by this environment as the market is really hitting our stocks. So I think if you were to look at the next 5 years, and if you were to give us that 5-year investment time horizon, we are the closest you'll find to a venture capital fund in the public equity markets. If you were to give us that 5 years, given our expectations for growth in these new technologies, I think we're going to see some spectacular returns.
Have we seen peak market impact yet, and what should investors be focusing on here?
It's very hard to say if we've seen peak market impact. I know the markets are getting hit today. Typically, the way we see the peak is through the VIX, the volatility index. And it has moved up. It's in the mid-30s. I'm not sure what this morning is. And the shock in 2018 and the one before that got us into the low 40s. Of course, the coronavirus got us to 80. But we're getting close to those cathartic moments in the past. I would be surprised if we do go to the coronavirus levels, because remember, people were expecting a depression. The whole world shut down. This is not that. This is going to cause a lot of problems from a purchasing power point of view. I think the risk of recession has gone up dramatically as purchasing power is dropping dramatically. In the U.S., the consumer saving rate already is down to levels we have not seen since 2013. So that buffer that the stimulus payments created during the crisis, that's gone. And so consumers are probably going to pull back. Sentiment suggests they will.
I believe that this shift towards passive and benchmark-sensitive investing, meaning, mimicking indexes, which is kind of mindless, is very backwards looking. The stocks at the top of these indexes are there because of what has happened historically. I believe this is the most massive misallocation of capital in the history of mankind. We have ahead of us the most magnificent opportunities because of the massive amount of innovation that's taking place, and yet the fear has pushed investors back to their benchmarks. Innovation solves problems. We now have a lot more problems. That 358% increase during the coronavirus is because right before it, we were slammed. We were slammed because of risk aversion. Once again, everybody going back to their benchmarks. And then everybody woke up one day and said, wait a minute, innovation is going to help us solve these problems, and we certainly were beating that drum, and anyone who got in near that low had a tremendous ride. I feel we're back there again, and now with the Ukraine-Russian issues, again, we have many more problems, and certainly when it comes to oil, this is only going to accelerate the push towards electric vehicles and autonomous transportation.
Which is good for your number one holding, Tesla.
Tesla.
Right?
Cathie goes on to say that within a year, there has been a sudden restraint on both monetary stimulus and fiscal policy stimulus, and there doesn't seem to be any in the near future. Now, the potential for a tax package for financial relief, Cathie says, is extremely low because of the midterm elections right around the corner, as well as the economic downturn with rising gas prices, as well as foreign conflicts. Some have been predicting that inflation would spiral out of control. Over the previous few years, the Fed has been overly optimistic about the prospect of lowering inflation. They'll have to do a lot more than a 0.25 percentage point hike every few months if they want to remain ahead of the curve and slow the economy. What do you think about Cathie Wood's economic outline? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.